This is the Texas Land Guys podcast, hosted by brothers Tim Dosch and Tom Dosch. With their partners David Marshall and Tripp Rich, they have built DMRE, the leading land brokerage in Texas. With decades of experience brokering deals between landowners and real estate developers, they take you inside the deals that move the market.
Welcome to the Texas Land Guys podcast. Today we have our first time that we've got our Austin studio up and running. So Tripp Rich, great to have you on the show from Austin.
Thank you. Excited to be here. Excited to have it set up finingly.
We got the full Texas triangle covered now.
We do. So we have Tim in Houston. I'm sitting here in Dallas. We're about, guys, this is our fifth quarter to do the podcast. So we're something like 70 episodes we've recorded, probably more than that we've recorded. We're in the 60s as far as what we've released. But we've always wanted to get the third studio up and running. We just had to work out some of the technical difficulties and coordinate that. But Tripp, it's great. It's great to have you. I think you're going to bring a lot to the podcast. And so you'll be much more frequent on here, and excited to for our audience to get to hear more about what's going on in Central Texas.
Yeah. Well, thanks for having me. I'm excited to be here and super excited to bring the energy. So let's get after it.
Yeah, it sounds good. Well, I guess we're talking about what we wanted to hit today, and we thought probably nothing better than to talk through what we've experienced in the first quarter of the year. And so the last couple episodes we've launched have been a little bit less directly on the topic of the market and deals and trends. But Q1 of 2026 has had a lot going on, both in the business and then things that are bigger picture that are impacting the business. And so I think this will probably be a two-part episode, just because there's so much that we want to talk about and hit, that I think we're having a lot of fun, even just earlier today as we were talking through things like AI, the Iran war, things that happened just, in the course of the first quarter that we didn't really see coming when we did our launch episode to start the year and talked about predictions and what we were thinking would happen this year.
Yeah, that's right. Well, do you want to first start talking about just the business and kind of the numbers and deals we're seeing and where the current trends are?
Yeah, I think that would be good. Maybe we start there and then we can go out. I would say that what we did say at the beginning of the year about this is our expectation as 2026 is almost like a 2025 2.0. That really has continued to pan out. I think that we've talked about this on a lot of podcasts that, survived to 2025, and the expectation was things were going to get a lot better. And then 2025 was a tough year. 2026 is turning out to be, I wouldn't say a bad year, but it's also it's not going to be a really good year, just because there's so much uncertainty in the market around some of the things that are going on geopolitically, and just uncertainty around rates, construction pricing, rents, consumer spending, a lot of those big topics. But why don't you guys, I'll let you guys go first on what you're seeing in your markets. Maybe we go asset type by asset type related to land, and what we're seeing, what the temperature is of developers and investors to start the year.
Yeah, it's funny because I had a meeting yesterday with one of our really good clients out of Austin, who's a large multifamily developer, and he said the same thing. We were talking about the market, and he just said, 26 is 25 2.0, but maybe a little bit worse, because I think when you look at 23, 24, and 25, we kept thinking, well, at least it'll get better next year. At least it's coming back, and there's almost been like this wave, because in Houston, every couple of years we have a downturn, then you have a big wave that comes back, and the market's hot again. And so I think we definitely feel that way in Houston, and then Austin and Dallas have had such hot markets that there's this belief of, well, it's going to come back and pricing will come back. And so everybody's always talking about that. And this is the first year I feel like no one's really saying that. There's not this belief of it's going to come back. Rates are going to come down. I think rates seem to be, maybe holding steady. Maybe they go down a little bit. Maybe they go up a little bit, but there won't be a dramatic change there. I think multifamily specifically is kind of interesting for Houston. We added 49,000 units of multifamily in 23 and 24 combined. So just a massive oversupply for Houston. I think a lot of that was all the deals that happened in 21 and 22, which were great years for our Houston office, transacting a lot of deals. And then you get to 25 and it drops to 14,000 units. And now this year we're projecting 11,000 units. So multifamily in particular is really fallen off. What's interesting is we're seeing really good pricing, probably almost record-breaking pricing on the really quality suburban sites where there's high barriers to entry. And it's just because there's not a lot of them, and all the activity is going to those sites. So we're seeing, pricing in the 20 to 30 range for these high-density surface park or even garden-style suburban sites. But the infill market is really difficult. There's some activity, but it's pretty slow for multifamily. And then the commodity sites that we were seeing, like these attainable deals and PFC deals we saw a couple of years ago have really dried up. And so we're seeing even some of the stronger sponsors having trouble getting deals capitalized and just seeing softer rents across a lot of the market, suburban and infill.
Yeah, Tim, that's pretty incredible. So if you had over 50,000 units deliver in those 2 years and then around 25,000 deliver the next 2 years, any idea what I think the outlook is for like next year? Because it doesn't seem like there's a lot of activity and it takes so much time, for these projects to come together, for them to be permitted and plans and then to break ground. So you'd almost expect that next year it's probably going to be a pretty low supply number again.
Yeah, it'll probably drop even more because I think, like what you're saying, people think when they hear 49,000 units delivered in 23 and 24, they're probably thinking, well, that means there's a lot of land deals in 23 and 24. What it really means is there's a lot of land deals in 20, 21, and 22 because it takes so long to deliver units. So, yeah, you're right. I mean, I think with the fact that the infill market is shut off and we may see like 1 or 2 deals get done in the infill market this year, and then suburban is really difficult. I think you'll just see that number continue to fall. And so we do think we'll hopefully start seeing rents come back. Rents have been soft. I mean, in the infill market with pretty much no supply, we're seeing these guys have to give 8 to 10 weeks of concessions. So, that you'd think that it'd be going the other way with so little supply for years. We haven't really seen a hot infill market since probably 21 and maybe part of 22. So I think we will see, we're still working multifamily hard and we're doing deals. It's just, there just aren't as many of them and they're tougher. We are seeing some of the better groups drop deals, which has been hard. But I think you're right. We'll see probably in 27 and even 28 lower supply of units added. And then at some point we might see the market bounce back, but you won't get a lot of supply until probably later in the decade, maybe 29 and 30, just because of how long it takes to deliver units.
Yeah. Well, one other question, and then Tripp, I want to get your take on this too. I had a conversation yesterday with the landowner, and Tim, something you just said reminded me of it. He's owned this property. He was older guy, owned this property in their family, I think since the 50s. So they run cattle on it, but it's like an infill type site. You wouldn't even really realize there's 30 acres, close in like this. And they've been talking to brokers. They're trying to figure out what to do. And he asked a really good question. He's like, I'm hearing that it's not a good time to go to market, but you could tell like he doesn't understand why at all. And that's the thing about our business. A lot of landowners don't understand. We'll say, the market's hard, but what a landowner sees is they see a ton of construction down the street. They see all these homes getting built, all these things happening. And so his question to me was like, I don't know why it's not a good market. It's is it the midterm elections that's going to be coming up? And he's like, would it be better for me to wait a year? And then when I answered that question, and my answer was pretty much, I don't think it's going to be necessarily better in a year. So I don't know that I would wait a year if that's the time frame.
Yeah.
Then he's like, well, should I wait 2 years? And he started, and he's like, if you can look out that far. I was just interested, like, Tim, could you just explain real quick to our audience, especially to a landowner that maybe is less on the side of just being in the business every day, when we say like the market's hard right now, what we mean? Because I think they see like population growth in Texas, lots of good things happening, and it's like hard for them to understand what we mean by the market's hard right now.
What's even more complicated about it is that it's not necessarily that every site's going to be the same. Because I think people think of land, they assume it's almost like a stock, almost like all land is just like one stock, and it just kind of goes up and down, and it's fairly easy to monetize. And the reality is it's not like that at all. And so you have some of these really good suburban sites. Like I said, we're seeing the highest pricing ever, and they're getting capitalized. I mean, we're seeing some crazy aggressive, like people taking out 3 phases of suburban tracks at the same time, paying like $25 a foot, which is, we never would have even thought that was possible in the past. And so it's like, how could that exist when we're saying the market's hard? That doesn't make sense. But then at the same time, like I have a listing that's kind of a commodity site, and it's going to be really hard to get capitalized for multifamily. You could build multifamily on it in a hot market, you would see it happen. But the problem with our business is in a difficult market, what it might mean is you just can't even get it done.
Yeah.
It's not because our client was like, I'd be willing to I'd lower my price, 15% for a really fast deal. And I was like, unfortunately, that's not the way it works. It's not like you just drop the price a little bit and then it gets capitalized. And so I think to answer your question, why it's hard is that capital is really tight right now. And so if you look at the fact that rates are still high, that means that cap rates are high. And so you have a really large number of multifamily developers and investors who bought multifamily deals, investment sales deals, or built deals in the past 4 years at different metrics because cap rates are lower. And now they're holding all those deals and they don't want to sell them because if they sell them, they'll lose money or they won't make that much money. They're hoping rates fall and they can sell them and actually make some money. And so because of that, and because of the fact that rents are soft, there just isn't a lot of capital for deals. And so investors, institutional investors are not going to take a risk on a site that's just a commodity site. They're going to look at the really good sites and maybe make a bet on those are going to outperform, but they're going to be really careful where they invest their money.
Yeah, that's good, Tim. Thanks. And Tripp, I want to hear your opinion on market pricing in Central Texas, because Tim brought up another point that I think is interesting. So give us an overview of what's going on in the different asset types in Central Texas, but also answer the question of, when Tim says $25 foot in the suburbs, what he's not saying is $25 a foot in the suburbs and it's closing in 3 months. It's like those deals are still taking a long time. And that's another thing within the markets we're in. I think in your market right now, you've been telling me there's a lot of landowners that actually do need a sale to happen. So they're looking for what's the number I could actually move this at? And then the question is are there buyers there? So do you want to just kind of talk about what's going on?
Absolutely. Yeah, it's really interesting to hear you guys talk about that. And Tim, you mentioned the big numbers on the multifamily sites in the suburbs because, Austin's such a dense city. So we're pretty much seeing the opposite on multifamily. Over the past 3 or 4 years, we've just delivered a ton of units in the suburbs where, frankly, it was easier to get a land site under control, easier to get it capitalized, and quicker to build, quicker to deliver. And so vast majority of the suburbs that didn't have really high barriers to entry got hammered with a ton of units. And we've seen rents are down, close to 30% in the suburbs. And so it's just made the suburbs, for the most part, outside of a couple of pockets, basically impossible to move dirt or move deals. Just because, the math doesn't math out there. And Tom, to your point, there's a ton of landowners that we're talking to right now that have sites. I mean, there's sites that we're marketing for people that we're, explaining that it's just going to take time. And I think that is kind of where we're trying to bridge the gap, is figure out these and have these conversations with landowners that we're having weekly that are, asking, hey, well, I need this sold. I need it sold before the end of the year. But unfortunately, it's not really a component of price to a degree. I mean, yes, it is, at a certain price, someone buys it, but it's at what price and is there a market for that? And, unfortunately today, Austin still it's still stained from the last cycle. A lot of people have gotten burned on development deals here, and a lot of these deals are underwater, and equity's just still holding that X on Austin today, and it just makes it a really difficult market in the suburbs. What is interesting, what we are seeing that's positive, has been we're starting to tie up infill sites again. We've got more than a handful of clients that are making offers every week particularly on infill wrap opportunities, and that's been pretty interesting to see because I think we're headed back to it's a flight to quality. People don't. I explained this. I remember having these conversations in 21 and 22 when we were tying up and selling a ton of land, specifically 2020 and 2021, tying up all this land in the suburbs and asking these guys hey, do people actually want to live here? When people move to Austin, it's you want to live within 5 to 7 miles of the city and be inside the city and where all the energy is, where all the events and everything's happening. And, does this make sense? And they were all just well, we can get equity. So
yeah,
we're doing the deal. And I was like, got it. Okay. And then we fast forward 5 years later and it's back to a flight to quality. I think people move here and they want to live just west of downtown or on the east side or near south or near north, as close to downtown as possible. And so we're starting to see, pretty strong rents and a couple of pockets in the urban infill, and the local groups that I think are the smart ones are moving early and they're tying up sites. Now, granted, to your point on time, Tom, it's definitely like, 18 to 24 months to get something closed. If it is something that's a lot more quick, then it's got a discount. It has a little bit of risk. So we're seeing a couple of those happen, but I'd say for the most part, it's deals that are at a pretty healthy number, but they have a lot of time attached to them.
And when you say good infill rents, you're talking about like crazy infill rents, right? I mean, some of what you guys have told me is pretty incredible.
For downtown, we're seeing on a couple of assets, we're seeing some $5 rents, which is pretty impressive. Yeah. For the balance of that, though, like no one's, to my knowledge, is really, maybe a couple of groups, but no one's actively out there being like, okay, I want, or I can go build high rise today. Like even with those rents, construction costs still kill it. And there's no exits really to support it, except for maybe like the 6X deal. And even at that price of where construction cost is today, it's going to have to trade higher than that to make sense. So guys are basically saying, hey, okay, if I can go be 7 blocks from there and build a wrap and get, 340 rents, then I'm going to do that all day. And I think those deals get done. I think in the good.
That's incredible. So you think north of $3 rents on wrap is doable in Austin?
That's what we're seeing in the good submarkets. Yeah, like if you go West Fifth or Miller or anything on South Congress or South Lamar that's north of Old Torf, they're getting north of $3 rents, which is great. Super helpful. And I think that's why we're going to continue to see wrap sites get done and get chased after. The other reality is like we had mentioned, we sold way more garden multifamily sites in the last cycle than we did infill sites. And it's just because it's so hard to get infill deals done. Like the sellers are difficult. There's a lot, usually like assemblages required. And like the biggest headache is the city. It's just it's still really difficult, but luckily the market's cooled off and I think it's going to create some opportunities. And, unfortunately most of these sellers in the urban infill, don't owe any debt. Nothing's really changed. They're just sitting there going like, well, I want the old pricing.
Yeah.
And some of these groups are getting to the point of going like, okay, well, I'll pay you that, but I need 2 years to close. And then of course it goes down the conversation of the sellers being like, well, what if the market changes or gets better? Can I have a free contract if something better comes along? It's like, no.
What's interesting about Houston is those comparable sites in Houston for wrap, we're seeing like, low $2 rents, maybe $2.25 effective, which is, in some cases over on Washington, like, $2 rents or even slightly south of $2 rents on product that's, a couple years old. So that shows you why it's so tough to do infill in Houston because the rents just aren't there.
Tripp, you'll appreciate this. I had a developer ask the other day, do you guys still have a team in Austin? Just because of how difficult the market is. And so I think for what I want to say with that is you guys had the fastest start to all of our offices this year on closings.
Yeah.
So you guys have really shown out and figured out a way to get deals closed, which I think is impressive because if you're in the business, there's probably not a harder part of real estate to be in today than doing development land deals in the Austin area right now, just because there's been so many that have been built. So kudos to you guys.
Yeah, not sure who said that. I've got a couple guesses, but we'll leave that off. Yeah, it has been really interesting to see, and even like talking with other developers and brokers. It's been like a blessing, and it's felt really nice talking with them because they've been like, "Yeah, you guys closing anything?" And I'm like, "Well, yeah, we just closed our 9th deal yesterday, and we had 8 closings in December, so." And they're like, "What are you talking about? What's selling? Who's buying land?" And so that has been nice. And it's big shout out to the team. Everyone, we have a really small, efficient team these days. But man, everyone's grinded really hard to this downturn. And a lot of people have shown their true colors and it's been a really positive experience. A lot of the stuff that we're getting closed as well has been, we've seen a huge, and I think we shared this with you guys and same for Dallas and Houston, but like iOS has been on fire for us here. That's a product type that's, gotten really active here in Austin. And I know my guys are making offers on those sites every week. And even starting to chase some, development iOS sites. So that's been pretty interesting. Balance of the product types for Austin, I think single family kind of fell off a cliff. They can't pay much for finished lots right now. And so it's a lot slower than it has been for us. Like that kind of floated our boats for the past, call it 2 years, was a ton of single family production, but most of the builders dropped the big contracts. We were able to get some closed last quarter last year, but that's been pretty slow. Surprisingly, build to rent guys have been kind of creeping back in as well, asking about some of those opportunities. But again, very particular submarkets where I think it makes sense today, like based on rents that you're seeing today and home values, et cetera. The last two I'll speak on for Austin specifically has been retail development. It's still on fire. Anytime we bring out a retail opportunity that's, well located, we're getting multiple offers within the first few days and running a competitive process, which has been awesome to see. I think like we just brought a multifamily site out in Bastrop to market. There was a 2-phaser, and I think we'll end up selling the first, the second phase that's on the frontage, which is also a great retail site, to a retail group, assuming we get the rezone done, because they were paying well north of what the multifamily guys can pay. So
wow,
that's been cool to see for retail. And, we've had so little retail development in the past 5 years here, and there's such a high demand and such a need for it with all the rooftops that came online. So that's super exciting. And then the last one I'll speak of that we can maybe talk about a little bit later is just the data centers. I think I found an updated map from the Austin Statesman yesterday that like within Central Texas, which I think they're including like San Antonio all the way to Waco and Austin, everything in between. But I think there's like 70 proposed data centers just in Central Texas. Now, granted, a lot of those won't get done because of, power needs, but it's pretty wild to see. And I'm sure you guys are experiencing it in Houston and Dallas, I imagine as well.
Yeah, we definitely are. We'll get there in a minute because that's a little bit of a carrot you're dangling for us to take a tangent into some AI conversations. But I think the trends across our markets are they're pretty similar, because in all of our markets, I think single family is pretty difficult right now. Even multifamily is pretty difficult in all of our markets to get equity. Like there are certain sites, and there's a smaller percentage of the market where it makes sense to go do development for multifamily, but it's difficult to get equity. Tim, our market is really similar to Houston in that if it's a really well-located core suburban site, there's interest. But then just like you said, Tripp, if it's more of a tertiary commodity, there's no interest in going out in the suburbs because it's so overbuilt because we had so many deliveries. But then we're also seeing this interest to come back in and do urban and do wrap sites because construction pricing is way down. So if it used to cost $300,000 a unit to build a wrap deal, now we're hearing about like $235 a unit, $240 a unit, all in, including the land. So it's come way down. Our rents are probably between the two markets because we've put a couple deals under contract to start the year in urban, kind of like city of Dallas, close in suburbs for wraps. Those deals, the comps are like probably $240 to $280. So kind of in between what you said, Tim, like low $2 and then not quite to $3. We definitely would have some areas of town getting those kind of rents, but then the barriers to entry in those locations are, there's like nothing you can really do. There's just not zoning or sites. I think industrial might be where there's the most disparity because from what I'm understanding, Houston and Dallas still have a ton of demand for industrial, and Austin's probably just still a little too overbuilt. Would you agree with that, Tripp? That's probably the area where maybe it diverges a little bit?
Yeah, I think that we've got a ton of supply coming online. We've still got some demand, but for the stuff that we're chasing or guys that are calling us, it's usually they have like a user in tow or something that they know that maybe the rest of the market doesn't, or chasing like affordable infill shallow bay sites, that are 6 to 12 acres, but again, like still really affordable and well located. And I think those projects continue to get capitalized and leased up with ease. But most of these guys want to build and scale, and I think scale's tough when you've got millions of square feet. Still coming online.
Yeah. I mean, everyone realizes there's going to be a need for more and more industrial. Probably like of all the product types, it has the best future. But just in this moment in time, there's a lot of supply. And there's certain areas of Dallas, like we had there, a couple of years ago, I guess it would be 24, probably 23, 24, when interest rates went up, all the focus on industrial was around the airport and like infill close in. But then now that area has a lot of vacancy because there were so many projects that got built. So now the focus is bulk and going out but there was a lot of vacancy in that space, but because the demand got shut off or the development got shut off for 2 years because everyone was infill, all that leasing, all that's leased up now. So now it's like you can't go find million square footers or even like 500,000 square foot buildings. So there's a big rush to do that. But then there's already developers talking about, well, because there's such a rush on bulk, that's like the herd. Everyone's pursuing that. Maybe we need to come back in and start looking infill again. So our business is so much about just demand and supply and how it fluctuates. You know, like a really good area could just get overbuilt. And then in that moment in time, it's difficult to make projects make sense.
Yeah. I mean, it's interesting you bring that up because like in Austin right now, I would say the bulk of supply that's under construction or proposed is kind of all around, 130 and 71, especially like up and down 130 along 71 right there. There's just so many projects that have been proposed or either proposed or under construction for quite some time. And at first, before, call it a week ago, I was like, man, that's a ton of supply. It's a good pocket, but it's like, that's a ton of supply to hit. It's going to probably take some time to lease up. And then Elon comes out and announces the Terrafab project, which immediately you're like, okay, that's going to produce plus minus 5,000 jobs. And then you think about all the suppliers that come around chip making and him having a full soup to nuts chip development factory right there makes you think that all of that space now could get leased up easily. So I don't know. It's interesting to see.
Why don't you talk a little bit more in detail? And Tim, I know you were talking about that plant too. I mean, that's amazing what he's trying to do. I'm sure a lot of our audience is familiar with that, but probably some aren't. But just the numbers around his vision, what he's trying to accomplish from like a global supply of chips, but then also the impact that's going to have on the Central Texas market is incredible. So when do you kind of get into that?
Well, I can go through some of the numbers. So they're saying that eventually it could be 100 million square feet of space, which is pretty incredible. To even I don't even know if I can like comprehend like how big that is. The first phase is 20 to 25 billion. They're talking about 200 billion chips produced a year. It was pretty interesting. He was talking about, so right now global output is around 20 gigawatts a year. He's talking about a target of 1 terawatt of compute output per year. So 50 times compute production globally. So to think that would all be in Austin, and then talk, like you just mentioned, about just where industrial is in Austin right now and space is close to that. I mean, we're talking about probably decades of production with this and just a massive economic, boom for the area. It's almost hard to quantify what that'll do.
It really is. Yeah. And it's hard because it doesn't happen overnight, even though sometimes things with Elon do happen overnight. So I'm interested to see how quickly he gets it on the ground. I think phase 1 was supposed to be cost $20 billion to develop. But you got to think over the next decade with producing that many chips and jobs, it's going to have a positive impact on Austin's economy. And also I think it just, resurges the fact that Austin's become like a very main tech hub in the country, outside of like San Francisco. I mean, it's incredible the masses that we have and what he's built, and especially that XAI and SpaceX have like kind of joined up to develop this Terrafab is pretty special. So excited to see that. I mean, at this point, I think robots are going to be in everyone's homes within like 5 years, and that's how kind of he sees it as well. So he's meeting his own demand.
Well, two things I think that could really impact Austin becoming the next Silicon Valley, and the Silicon Valley really kind of falling apart, in the future, is the Democrats are already starting to really oppose AI development. Tom was telling me before we got on about AOC and Bernie Sanders wanted to halt all data center development across the country.
Yeah, I mean, they're trying to pass a regulation right now. If you have under construction data centers, they have to stop.
Yeah.
Which is not going to be passed, but it just kind of shows you where they're coming from.
If you have these blue states really trying to regulate AI and trying to, really halt AI and halt the development of AI, and at the same time, both New York and California are starting to tax billionaires specifically. I think California has a 5% billionaire tax. So you have billionaires leaving California and New York. And so it just makes sense that Austin, with this investment Elon's making, is going to draw more and more of, these tech companies and all the AI infrastructure development, all that stuff. Seems like Austin could become the new hub for that. So it's pretty interesting.
I think it's incredible. Tim, it makes me jealous, and it makes me feel like Houston and Dallas need to get in on the big AI companies. Hopefully we can attract someone, maybe if Anthropic is listening or OpenAI, maybe they'll come pick Houston or
Dallas. Probably has a better shot than Houston. I don't know, but we benefit a little bit when you guys get things.
We both have so much infrastructure. I think that's the thing about Texas is our infrastructure is so incredible to attract. And that's, I think, what attracted Elon was probably land values, pro-business, the infrastructure. the amount of land, all of that. I mean, who would have thought he would go plop everything down where he is? But there's so much opportunity there versus trying to do that like in Silicon Valley.
Right. Yeah. But it is really interesting though, because I always wonder that with like Dallas and Houston. I mean, it's like Dallas is about to have the second stock exchange in like the country.
Y'all Street.
They picked that. Yeah, that's what I'm saying.
Yeah.
Y'all Street. So it's and then there's so much land in Houston and in Dallas, and there's frankly better infrastructure there than in Austin. So it is interesting that he's chose it here, but I think it's only going to keep happening across the Texas Triangle. It's pretty exciting to see, but it kind of does make sense. What you guys said, it's pro-business, tons of land values, infrastructure. And I think it's where like ultimately like people want to live, people want to be like Texas is pretty awesome. So
you see a lot more residential growth kind of around that area because that area has not been as strong of a residential area. I know that there's industrial, but
we sold a ton of multifamily sites over there and some industrial land. And it's kind of like the last growth. If you're looking at Austin, like in quadrants and you said, okay, north, west, east and south. East has just been the slowest. And I think it's mainly due to like lack of utilities over there. Yeah. It's just been a bizarre thing. It's like west is the most desired and the most expensive and, the greatest schools and the highest demographics. But yeah, it is interesting because you're very close to downtown. You're very close to the airport. Most people that drive in from Austin are coming in off 71 or 35 right there. And so, yeah, the short answer is no, there hasn't been historically that much single family or even residential development over on the east side. But I think we're going to see that change drastically probably in the next decade. There's a couple of pretty massive projects within a stone's throw from Elon's Terrafab and Gigafactory. I think, Endeavor has the 2,500 acre Dog's Head tract that, Lord knows what that's going to end up being, but it will likely be a master plan that includes mixed use, industrial, residential, kind of all of the above. And then there's a couple, there's an alleged kind of data center Disneyland that's being developed east of Elon's deal. I've, talked with the owner and they've got some pretty big ambitions and plans with that project and allegedly have like a ton of interest. They're going to make it, tech savvy and safe.
What's a data center Disneyland? Is that a Disneyland for AI agents or is that Disneyland? What do you?
I'm just not going to say the name because I signed an NDA on it, but
you're saying it's like a really tech heavy Disneyland. Is that another way to say that?
Basically just like a tech community that'll be, centered around data centers but it'll still have, a place to live, an airport. Like it'll basically be like a tech city.
Oh, got it. Okay.
It's kind of how they envision it. And so
that's cool.
They've got the power and the water and they've got everything they need, and I think is
that like a Silicon Valley 2.0 or whatever the complex is in Silicon Valley where all the businesses are, startups
That's kind of how he pitched it to us. We were looking at it with a user and ended up going a different direction. But yeah, it's pretty interesting. There's some projects out that way that I think will change a lot of what rooftops follow and why over the next 10 years. But that's the thing is like, both the projects I just mentioned are 10 plus year projects. I mean, the second one I mentioned is over 10,000 acres. So
yeah, those are huge. Why don't we talk a little bit about just what we've seen closing in the first quarter and then just where activity has been on sites we've had out in the market and where we're seeing offers. I can speak to Dallas to start. I think you mentioned it earlier, Tripp, retail. We've had a lot of activity on anything retail we've taken out. And, we've closed some retail deals already to start the year, put some under contract. I think it's a function of so many people have moved to Texas and there's all these expanding neighborhoods. And we know very simply, it's like rooftops drive retail demand. And it's really been the retail demand that the demand is there. The product has not come on the ground. And so there's been really strong demand for land sites for retail. So that's something that we're definitely spending more time on than historically we would have spent time on just because the demand is so strong. And then on the flip side, we're getting a lot of activity on multifamily sites that we have out in the market. We closed a multifamily tract 2 weeks ago. It was a HFC HUD deal. And so what we're finding on multifamily is it either has to be the really well-located tract that Tim's talking about, or it has to be some kind of special financing, like you're getting HUD financing or it's an HFC, or it's just not a straight, market deal. We're working on some LIHTC transactions right now, which we normally don't. It's just never like something we set out to do, but like we have one that's supposed to close here in the next couple months that's getting good traction. And we're seeing LIHTC developers be pretty aggressive because there's so many bonds available. And then again, urban multifamily demand is strong, especially for wrap sites. Podium is very difficult. We are working on some kind of high-rise, podium high-rise sites, but you either have to have like the very, very best site to go do a high-rise, or you're probably looking for a wrap. And so we've taken out a lot of multifamily sites on the listing side in the first quarter for developers that owned a site and had plans to develop. Maybe it was a second phase, just maybe couldn't get it capitalized, or have another project they want to invest the capital in. I mean, there's kind of a wide variety of reasons, or even they just held it for such a long period of time. They could go develop it, but at this point, it just makes more sense to sell it. And we've had good activity on all those. Every site we've taken out to start the year and taken through our marketing process, done a call for offers. We've had several competitive bids. So the market's not easy, but positioning these better tracks, we're trying to really only work on the tracks, and we're being very, very straight up with landowners. And I told the landowner yesterday, I was explaining how challenging it would be to get her site zoned for apartments and then to get it capitalized for multifamily, because other brokers have been telling her this could be a multi-site. She's like, so is what you're saying is this would be like a Hail Mary? And I was like, yes, this would be a Hail Mary, like 100%. And I was like, maybe you still want to try the Hail Mary, but just know it's a Hail Mary. It's like there's a really small percentage chance this will happen. But yeah, I mean, we've seen, to start the year in Dallas, we've closed industrial, multifamily, single family, retail, senior housing. It's interesting. It's like it's not all of one thing. It's a variety of different use types and product types. It's much more focused on just well-located land for different product types. That's really how we've been running, because there's no product type other than really industrial that's just pretty much hot across the market.
Yeah, I think in Houston, we our first closing was a really well-located energy corridor site, which is pretty interesting because about 10 and 12 years ago, there was a wave of all these energy corridor deals that happened. And then we had this oil crash in Houston. And so that just died away. And land prices have come down enough, probably actually fallen in half since then, the energy corridor, which is pretty incredible, to the point we had one of our better clients who was able to capitalize a garden style 3-story product in the energy corridor. And so I think that'll be really good for them. It's a great site, and makes a lot of sense. So that got capitalized. They closed that. We're also closed a really well-located infill retail site. So kind of to your point, Tom, and Tripp, about how retail has stayed strong. These infill markets in Houston, you couldn't really build. It was really hard to build retail, especially at scales. This is a large site, 11-acre site. Would have been a multifamily tract, probably double the price for multifamily. But the pricing got to where a retail group could come in and build a really cool retail development with a lot of different users, different types of uses. So that was exciting to get done. And then similar to like what you're saying, Tom, in Houston, we're closing a lot of different deals, so different use types. So another single family deal closed, like a 130, 140 acre single family deal. We're actually seeing single family much weaker in Houston, but it sounds like it's maybe stronger than Austin and Dallas. We're still seeing builders make offers. We're seeing builders close deals. We're seeing a lot of developers put deals under contract. I think that the fundamentals are weak, and we're still seeing home sales are not strong. So not that it's a really strong part of the market. It's definitely a weaker use type, but we are still seeing some activity. We also closed an industrial deal. And industrial has been by far the hottest part of the market. We've seen land prices double in the industrial market. We're seeing developers go further out, going past the Grand Parkway, going all along the Grand Parkway. Anything that is close to the Beltway or more infill is getting up into the teens from a pricing standpoint, which is, for Houston is pretty incredible. So, and it's all across the board. It's these, kind of smaller, 10 to 15 acre, almost like infill industrial sites that are going really expensive. And then it's big, 100 to 200 acre in some cases along the Grand Parkway, these massive takedowns of land at it's still really good pricing in the $8 to $10 foot range for bigger industrial deals. So it's been kind of all across the board. One weak part of the market for a long time has been seniors. We're not seeing any seniors development at all. And I just don't, maybe we'll see it at some point, but it's been dead.
It's interesting, just that comment on seniors. I've heard so many times the pitches on our aging population and how that's going to be such an incredible opportunity in the market, but then we just haven't seen it pan out. We've closed a lot of those deals over the years and we haven't really seen it pan out. So that's a good point, Tim. That was the deal we closed was in Frisco. And so it's kind of a unique site. It's actually really close to my house. And so it was a really good site. And I think that was probably a big part of it. It's been hard for us to make those deals work too. One thing I was going to say on land prices was what I'm not really seeing in Dallas. And I don't think, it doesn't sound like you guys are seeing it either. I'm not seeing land pricing really come down and transact. Meaning like the deals we're closing are still closing at pretty good numbers. And then the sites where like someone would be willing to discount, people just don't want to buy them.
Yeah, that's because they're bad sites.
It's like it's the B sites that it's like, hey, it's down to 20 a door. Hey, it's down to 15 a door. Hey, it's down to 12 a door. And I'm like, man, it's not a price thing. It's like, it's decent real estate, but they're looking at it and they're like, well, hey, rents are down 30%. And then there's another 5,000 units proposed. It's like, this site could work in 2 years. It could also not work for like 5 to 7 years.
Yeah.
We've seen pricing come down, but it like to your point, Tom, it's for stuff that doesn't really have a market for today. The stuff that's desirable, if it has come down, maybe it's a little bit, but we're still chasing some sites. I made an offer with a group a couple of days ago that it was like 2022 pricing on a site that's in the urban infill. Now, granted, it has a 2-year, contract on it, or 18 to 24 month contract. But it's like, I think they, for the good sites, people are still paying up. It's been pretty interesting.
What trends are you guys seeing? Because another trend is we're seeing some pretty interesting office deals come to market, like the Mary Kay campus, which is really well known here in Dallas just because it's right on the tollway. It's really close to our office. Just came to market with the big brokerage shop. And so, it's in one of these submarkets where there's a lot of older office that you'd probably say it's like A- type office in the submarket. There's decent vacancy. And yes, you're on the tollway, so it's well located, but there's just such a push on the office front to either be in Uptown or to be up in Frisco or Plano, not kind of to be in this middle area. And we love being here. It's really centrally located, but there's just a ton of office product. It's all kind of this older vintage. And so that campus going on the market, it's a lot of land. It'll have probably a pretty difficult time getting zoned into like something that is big mixed use that doesn't incorporate some kind of office. It's just hard to believe that Addison will let it go like all multifamily or something. So it'll be interesting to see who gets it and what it goes. But we're seeing that. We're seeing a lot of developers trying to make these older office deals work. That's pretty much what's been going into foreclosure and auction. There's been several in the first quarter of Dallas that have come up for auction. The challenge we've had with them from a development standpoint is it's like they're 30% leased, but then those leases run out a decent amount of time, like 3-4 years. And so it's really expensive to carry. So you either have to carry it until it's empty, and then you're going to have pretty big demo costs because some of these buildings are big buildings. Or you have to figure out how do you negotiate buyouts of these tenants when the tenants know that they kind of can hold you hostage. So I'm interested in what you guys are seeing.
Well, I was going to mention, so one of our clients told me about 3 deals they're doing in Dallas, multifamily deals, 3 different office buildings they're tearing down. One cost $3 million to tear down.
Wow.
And they all had existing tenants they had to buy out. So it was a complicated deal, but they're building Surfers Park multifamily on all 3 of them. So that's pretty amazing. And he was actually saying like really watch Houston, Dallas the next decade is all. I think about Houston, there's so many of these old, terrible buildings, that are, probably B, C, D kind of quality. Like you're saying, they're almost being slumlorded now. There's a lot of vacancy. There's really no incentive to invest in the buildings and keep them up. You can't push rents. And I think as we see AI continue to progress, when companies lower their footprint, and then there also is just this flight to quality. People want to be in new buildings that are walkable, that are if they're going to go to the office, be kind of a cool building. So he was saying, like, I think we're going to see a lot of buildings, older buildings get torn down and see multifamily or something else get built in its place.
All right. Well, we're going to cut it there for today because this definitely turned into a 2-part episode. A lot of exciting things that we're going to hit next week on the second part of this overview of Q1. So definitely tune in and please do like and subscribe to our show, whether you're listening on Spotify or Apple or wherever you're listening, and then also on YouTube. We would love to see you like and subscribe and follow us. So please do that, and looking forward to part 2 next week.
Thank you for listening to our podcast today. If you have questions about land you own in Texas, send us an email at texaslandguys@dmre.com and follow us on LinkedIn to stay updated.